Welcome to this session on confirmation and settlement. In this part of the course, we will explore two crucial components of financial transactions: confirmation and settlement. These processes are vital in ensuring that all trades are executed correctly and that financial institutions and market participants can manage the associated risks effectively. Let's start by understanding the importance of confirmation and settlement in financial markets. Confirmation is the process of verifying that the details of a trade match the agreements between the buyer and the seller. This process ensures that both parties are aligned on the specifics of the trade, including the price, quantity, and other critical terms. Without proper confirmation, discrepancies could arise, leading to disputes or errors in the transaction process. Settlement, on the other hand, refers to the finalization of the transaction, where the actual transfer of assets or payments takes place. This step ensures that both parties receive what was agreed upon in the trade, whether it's the exchange of money for securities or other assets. The settlement process is critical for reducing counterparty risk, ensuring that transactions are completed smoothly, and that assets and payments are transferred as expected. Now, why are these processes so important? Accuracy. Confirmation and settlement help ensure that the terms of the trade are correctly executed and that there are no errors or discrepancies. This helps avoid costly mistakes that could lead to financial losses or operational disruption. Efficiency. By having clear procedures for confirming and settling trades, financial institutions can reduce the time required to finalize transactions, making the entire process quicker and more efficient. Risk management. Confirmation and settlement are key tools for managing risk in financial markets. By ensuring that transactions are completed accurately and on time, the risk of default or failure is minimized, creating a more stable and trustworthy market environment. In this presentation, we will dive deeper into the key practices that facilitate the confirmation and settlement process. We'll also look at the frameworks that support these procedures, helping to mitigate risks such as settlement failures or fraud. Welcome back. In this part of the session, we'll focus on the importance of confirmation and settlement in financial transactions. These processes play a critical role in maintaining the integrity of the market, managing risks, and ensuring the efficiency of operations. Let's explore the key reasons why confirmation and settlement are essential. 1. Mitigates risk. The first key point we'll discuss is how confirmation and settlement help to mitigate risks, especially the risks associated with errors and settlement failures. Outtrades. An outtrade occurs when there is a discrepancy between what was expected and what was executed. For example, the price or quantity of the trade might be incorrect, or the trade might not be processed as agreed. This could result in the need to re-execute the trade, causing delays and confusion. Confirmation and settlement procedures reduce the occurrence of outtrades by ensuring that all transaction details are verified before proceeding. Settlement risks. Settlement risks refer to the possibility that one party may not fulfill their obligations under the trade agreement. For instance, they might fail to deliver the agreed-upon asset or payment. By confirming the trade details and ensuring proper settlement, we significantly reduce the chances of this happening, thus protecting both parties involved. Proper confirmation ensures that the transaction details are correct and agreed upon by both parties before moving forward with the settlement, minimizing errors and potential financial losses. 2. Market integrity. Next, let's talk about market integrity. This refers to the fairness and transparency of financial markets, which are essential for maintaining investor confidence and the overall stability of the financial system. Documentation and verification. Confirmation and settlement are critical for ensuring that all transactions are properly documented. This documentation acts as an audit trail, verifying that the transaction took place according to the agreed-upon terms. By doing so, confirmation and settlement procedures help maintain the transparency of the market and ensure that all market participants are adhering to the same standards. Transparency. Without proper confirmation and settlement, discrepancies can arise, which can lead to miscommunication or even fraud. When transactions are properly documented and verified, participants in the market can be confident that the trades are legitimate and accurately executed. In summary, by ensuring that transactions are confirmed and settled correctly, we contribute to a transparent and trustworthy market, fostering confidence and reducing the potential for manipulation or fraud. 3. Operational efficiency. Finally, confirmation and settlement play a major role in enhancing operational efficiency. This refers to the speed and smoothness with which trades are executed, settled, and processed. Reduced disputes. Properly confirming trades and ensuring accurate settlements help reduce the likelihood of disputes between market participants. When all terms are clear and agreed upon, there's less room for confusion or disagreement, leading to quicker resolution of issues and smoother operations. Operational delays. Without efficient confirmation and settlement procedures, delays can occur, especially if there are errors or discrepancies that need to be resolved. By following standardized and well-established confirmation and settlement protocols, market participants can ensure that trades are processed in a timely manner, minimizing delays and optimizing the trading process. In the next slide, we will dive deeper into the specific practices and systems that support these key functions. Stay tuned. In this part, we'll explore key practices for confirmation in financial transactions. Accurate and secure confirmations are critical to maintaining the integrity of trade execution, mitigating risks, and ensuring operational efficiency. Let's dive into the best practices that ensure confirmations are handled securely and efficiently. 1. Secure communication. The first key practice for confirmations is ensuring secure communication. Importance of secure communication. Security is paramount when sending trade confirmations. These documents contain sensitive transaction details, such as price, quantity, and counterparty information, that could be exploited if intercepted or tampered with. If confirmation information is compromised, it could lead to fraudulent activities, disputes, or loss of confidence among market participants. How to ensure secure communication. Encryption. Using encryption to protect the data during transmission ensures that only authorized parties can access the confirmation details. Secure channels. Trade confirmations should always be sent through secure platforms that are protected by firewalls, two-factor authentication, and other security measures to prevent unauthorized access. 2. Automation and standardization. Next, let's talk about the role of automation and standardization in the confirmation process. Importance of automation. Automated systems reduce the reliance on manual processes, which are prone to human error.